Welcome to The Explainer. Today, we're going to peel back the curtain and show you what some of Wall Street's absolute sharpest minds are buying when they think nobody's looking.
Right. Let's just dive straight into this. We all see the headlines, right? Burry's shorting this, another guy's buying that. But their biggest, most interesting bets, well, those often aren't making the front page. We're going to look at the overlooked, the undervalued, and frankly, some of the downright strange investments that could hold some serious potential.
So first up, we've got this absolutely fascinating situation. You have two legendary investors, Michael Burry, the guy from The Big Short, and the activist investor Bill Ackman. And they are both circling the exact same, completely forgotten company.
And that company is Fannie Mae. Now, for a lot of you, that name is probably just a ghost from the 2008 financial crisis. Its job is to provide the cash, the liquidity for the U.S. mortgage market. Basically, they buy up mortgages from banks, which frees up those banks to lend more money. But oh man, this company has one of the most dramatic and controversial backstories in finance.
Just look at this journey. Fannie Mae went from being a Wall Street darling that made Warren Buffett an absolute fortune to becoming a total pariah during the 2008 meltdown. The government had to jump in and rescue it, and it's basically been in this government-controlled limbo for more than a decade. But now there's a real plan on the table for an epic comeback.
So here's the plan Ackman's pushing, and it's pretty clever. It's basically a win-win. First, the company uses all the money it's making to pay back the taxpayers for that bailout. The government gets to keep a huge stake, almost 80%. Then, the rest of the shares get relisted on a major exchange. Just that move alone could make the stock way more accessible and could potentially triple its value.
But Burry isn't just a one-trick pony. He's not only looking at these massive turnaround stories, he's also constantly hunting for these high-growth businesses that he thinks the market has completely misunderstood. And that brings us to his other really big, quiet bet.
The company's called Shift4 Payments. And yeah, you heard that right. It was founded by a retired astronaut. How cool is that? Anyway, Shift4 handles payments in really tricky environments where speed and integration are everything. Think about a packed stadium concession stand or a super busy hotel. And even though the whole payment sector has been getting hammered lately, Shift4 is just quietly, flawlessly executing its game plan.
And this, right here, this gets to the absolute heart of what Burry looks for. He's found this fantastic business that's growing incredibly fast. 37% revenue growth. It's beating its own ambitious goals, and yet it's trading at a tiny fraction of what its competitors are valued at. And on top of that, they just bought Global Blue, the giant and tax-free shopping. So the market has unfairly punished it, and that is exactly where Michael Burry sees his opportunity.
Now get this. In a recent blog post, Burry hinted at a mysterious way he's playing this stock. And if you know anything about Burry, that almost certainly means he's using options. So instead of just buying the stock, he's probably buying the right to purchase it at a set price in the future. And he only has to pay a small fee for that right. This creates what's called an asymmetric risk profile.
Here's what that means. If he's wrong and the stock goes nowhere, he only loses that small fee he paid. But if he's right and the stock takes off like he thinks it will, his return could be 8 times his initial investment, maybe even more. It's a classic Burry bet, a perfect example of asymmetric risk. You risk a little for the chance to win an absolutely tremendous amount. Okay, next up, Bill Gates. Now, through his foundation's massive investment portfolio, he is making a huge strategic shift, and it tells us a ton about where he sees real value in the world right now.
The pattern here could not be clearer. He's systematically selling off expensive U.S. stocks. He's even reducing his stake in Microsoft. And where's all that money going? It's flowing into what he sees as undervalued emerging markets, where there's just way more potential for growth.
This famous quote from his good friend Warren Buffett perfectly, and I mean perfectly, describes one of Gates's key international investments. It's a company that gets to profit from one of the world's most iconic brands without actually being the brand itself.
And that company is Coca-Cola FEMSA. They're the biggest Coca-Cola bottler on the entire planet, and they serve the fast-growing Latin American market. So you might be asking, why buy the bottler instead of the famous parent company that Buffett himself owns? Well, the answer comes down to one simple, powerful word: value.
Okay, look at this. The parent Coca-Cola company trades at a valuation of 22 times its cash flow. That's a pretty hefty price. But now, look at Coca-Cola FEMSA, the company that bottles and distributes that exact same product in high-growth Latin America. It trades at just 9 times cash flow. It is by far the cheapest way to invest in the entire Coca-Cola ecosystem, and you're getting more growth potential for a much, much lower price.
And finally, we turn to an absolute legend of macro investing, Stanley Druckenmiller. I mean, this guy has one of the best long-term track records in history for a reason. And he has found what he believes is an explosive growth story just south of the border.
His largest new bet is on a company called Tiendas 3B. Now, the best way to wrap your head around this business is to think of it as like the Aldi or Lidl of Mexico. It's a hard discount grocery chain. They focus on their own private label brands to offer good quality stuff at incredibly low prices. And the key here is that it's in the very early innings of its growth story.
Let's just pause for a second and look at this momentum. Their revenues are growing at a blistering 36% pace. For a grocery business, which is usually slow and steady, that is absolutely staggering growth.
And here's the beautiful part. Because their business model is so brilliant and low cost, their profits are actually growing even faster than their sales. Think about it. As they open more stores, their scale gives them more bargaining power with suppliers. That makes every new dollar of sales even more profitable than the last.
And this right here, this shows you the incredible runway they have ahead of them. They are around 3,000 stores right now, but management is convinced that the market in Mexico alone can support over 14,000. So they have the potential to more than quadruple their size without even looking at other countries in Latin America. The opportunity is just massive.
So, let's recap. We've looked at a bailed-out mortgage giant, a high-tech payments firm, a Mexican bottler, and a discount grocer. They all seem so different, right? But what can we learn from these seemingly disconnected investments? Well, it turns out there's a common playbook at work here. Here's the key takeaway. These investors are looking for value where nobody else is bothering to look, in weird over-the-counter markets, in emerging economies, in sectors everyone else hates. They find situations with a unique, unfair advantage, like Burry's asymmetric risk, or Gates's cheaper valuations, or Druckenmiller's superior business model. Then they identify a clear catalyst that's going to unlock all that hidden value, and then they patiently wait.
That right there is the question that these legends ask themselves every single day. And after walking through this, it's a question that you can start asking yourself too.